welcome to BloombergQuint. The IMF, in its latest World Economic Outlook, has cut the global growth forecast to 4.4%. That reflects a paring down of projections for the US and China, predominantly. For India, the IMF is predicting 9% growth in the current fiscal and 9% next fiscal as well. Gita Gopinath, first managing director of the IMF, with us. Gita, thank you so much for taking the time to speak to us on BloombergQuint.
Thank you. You're happy to join you.
Gita, let me start with the global picture. Two very diverse set of circumstances impacting growth projections in China and in the US. In China, it is a reflection of the stress in the real estate sector, which is flowing through into the real economy. In the US, it seems like a combination of lower fiscal support and also a turn in monetary conditions.
Yes, so there are very different factors that are behind the downgrades for the US and China. In addition to what you mentioned for the US, it's also that supply disruptions have lasted longer than we expected. So I think those three factors are behind the downgrade. In the case of China, what we are seeing is even greater weakness in the real estate sector than we originally anticipated. In addition, there are more lockdowns and more kind of targeted, localized lockdowns that we're seeing in China because of the Omicron variant and also because of the zero COVID strategy that they have. And that has been affecting the recovery in private consumption. And so these are a couple of the reasons why we have the downgrade for China.
Gita, more broadly for the global economy, is 2022 going to be a year when you have a clearer sense of the underlying growth momentum, where some of the year-on-year sort of pent-up demand, pent-up savings aspects start to play out, and you start to see what the underlying economy and the strength of it looks like?
This is certainly a year where we're hoping to get closer to normal in an economic sense, in terms of the fact that we hope certainly that over time there will be a rotation of demand back from goods demand towards services demand, and that will have implications for inflation too. This is also the year of the exit from extraordinary policy measures in pretty much all major economies that we're going to see. Not every single one of them, but for most of them. And the Fed is certainly going to be raising interest rates this year by multiple times. So we're exiting the kind of extraordinary policy support that was provided. And the hope is that as we get better used to dealing with with variants, that we go back more to normalcy, spending patterns return more to normalcy. But again, I think what is absolutely true about this year, just like previous years, is a very high level of uncertainty around the outlook.
Let me get to inflation, which is front and center, at least in the investor's mind. Your assessment of inflation is that so far it is supply side driven, fuel price and commodity price driven. You expect it to ease towards the second half of the year, but there's a big if there.
No, our expectations, our prognosis for inflation is not that it is entirely supply driven. There's a strong rebound in demand that we've seen in many parts of the world that has also fed into commodity prices. So it's not just a supply story for commodity prices, but it's also the big recovery in demand that we have seen. And so there are the standard macro factors that have an impact on inflation, which is the amount of fiscal stimulus provided, the monetary policy stance, the behavioral reactions in the sense how quickly people have come back to spending. Those are more standard, but then you combine that with a whole bunch of non-standard features, which are very pandemic specific, which is people spending more on goods as opposed to being able to go to restaurants and so on. The fact that workers are falling sick and then they're held back from returning to work. Some of them picking early retirement, which is what we're seeing in the US, and then the global supply chain and the breakdowns that we're seeing over there. So it's a complicated process to forecast the path of inflation. Our expectation is that from the second half of this year, we would see inflation coming down pretty much in all countries. But for some countries like the US, even though it comes down, it still ends the year quite a bit elevated relative to the 2% target for the Fed.
The fear always is, Gita, that some of this starts to feed into inflation expectations, and then that leads to wage price spirals and so on, and second round impacts. As things stand right now, is there any clarity on whether we are seeing that impact on expectations, at least in the US? I know, local country conditions are very, very different, but in the US?
In the US, if you look at inflation expectations, you look at medium-term inflation expectations, they look well behaved, they look anchored. The very near-term inflation expectations have gone up, consistent with what we're seeing in terms of the recent inflation data. But that's, if you look at labor markets are quite tight. We are seeing nominal wages go up at a rate faster than pre-COVID. But again, overall, while there's been an increase, we're certainly not seeing a wage price spiral. We're seeing inflation wages going up particularly strongly for some workers, those that work in leisure and hospitality, less so for certain other sectors. So while overall, I would say wage inflation has picked up, and that's one of the reasons why you have much more broad-based price inflation, and which is why the US Fed will be raising interest rates. But we're not at this point in a wage price spiral or any sense in which we have de-anchored inflation expectations.
For the rest of the world, Gita, as the US Federal Reserve starts to tighten and raise interest rates, I think memories of what had happened during the taper tantrum are still very much alive and fresh. The implications for financial conditions tightening globally, particularly for emerging markets, how do you see that?
That is one of the risks that we flag in our outlook, which is that if it so happens that interest rates start rising even faster than what we expect given the US interest rates increases, or there is this excessive turbulence in markets and borrowing costs shoot up around the world, then that certainly will have an impact on many emerging and developing economies. But again, it's not one story fits all for several of them. Unlike compared to 2013, 2014 of the taper tantrum period, there are several countries that have much more foreign exchange reserves. Most of them haven't received a big surge in capital inflows. They don't rely very heavily on foreign currency borrowing. But on the other hand, there are countries that have large external financing needs, are borrowing short-term, borrowing in dollar terms, and they are particularly susceptible to this, and that's something we're watching closely.
Gita, a few words on India. Growth for the current fiscal is pegged at 9%. That's broadly in line with what the first advance estimates locally have suggested. For next year, 9% growth that is being projected by the IMF. What are the underlying conditions you're expecting? You're expecting that some of the demand strength will persist. The sort of flip side of the story is that some people are concerned that consumption will start to weaken as underlying scarring starts to come to the fore.
So India's has been recovering, and it came back to pre-pandemic levels. But again, there is still quite a bit of gap between where India is right now in terms of its recovery and where its potential is in terms of the level of output it could have. And so there is the underlying momentum where we should continue to see a recovery both in consumption and in investment. It is a gradual recovery, especially relative to pre-pandemic trends. It's a gradual recovery. We have a very small downgrade for the current fiscal because of Omicron and because of its concentration in the first quarter of this year. And that kind of postpones the recovery a little bit, which is why the number for the next fiscal goes up. But again, there is a lot of uncertainty. On the plus side, I would say that we're seeing that the stresses that we expected in the financial sector are somewhat less than what we were worried about last year. And that can be a positive in terms of the recovery. But again, this is, like I said, this is a pretty challenging environment. India is in, not just within itself, but also relative to the global economy, given US monetary policy tightening that's expected, the implications that could have for interest rates, the energy prices we still have, the geopolitical risks out there, energy prices could shoot up some more. And all of these would be challenges for India.
Geeta, locally, monetary policy has chosen to look through the higher than targeted inflation, the premise being that the underlying recovery is still fragile. But going into now the third year, do you think the baton would probably need to shift to fiscal policy to address some of that scarring, while the role of monetary policy should return very much to the prime mandate of inflation control?
So, I mean, inflation as such has been at the upper band, and core inflation has been pretty sticky at the upper end of the RBI's band. Now it's at 6%. So while it's not, substantially above that, and therefore in that sense is a bit different from some of the other countries you've been talking about, but this is something to keep an eye on. There is slack in the economy, so that gives you pause to say that we're still waiting for a recovery. But at the same time, these things can change pretty quickly. And if we have a prolonged period of inflation being stuck at a particular number, then that can shift, again, expectations there. So that's something to pay attention to. I think it would be helpful, again, the RBI has been communicating strongly, but to communicate some more on what it expects to do on the interest rate path, and especially in this global environment when the US Fed is going to start tightening interest rates.
A word on fiscal policy, Geeta, and this is something you allude to at a broader global level as well. After 2 years of expansive fiscal policy, fiscal headroom is lower in a number of EMs, including in India. And the debate is whether to use that headroom to spur capital expenditure, job growth, or to use that space to provide income support, job support via social security schemes such as the Rural Job Guarantee Scheme in India, for instance. That prioritization and that juggling is going to be tough this year.
Our view is that India's fiscal policy can stay accommodative for some more time, in the following sense, which is that if you look at the cyclically adjusted fiscal deficit, it should have more of a neutral stance, which means that the overall deficit would look somewhat accommodative. In terms of the pieces of where the budget should go on, there is certainly one piece that should address the very unequal recovery within the economy. And that dimension, making sure that the Rural Employment Guarantee Scheme remains well-funded, the fact that one could consider providing free food staples for somewhat longer as opposed to letting it expire in March. But the other big important areas where attention is needed is, again, more spending on health, on education, because there's been a big hit to learning. The schools have been shut down for a long time. There's been a big loss there. That has to be addressed. And the government has been doing a lot of public investment, infrastructure investment. That should be continued, including with the, helped with the asset monetization program. And all of this should be done while communicating a credible medium-term fiscal framework on how deficits will be brought down. I think that would be required to make sure that financing costs for India remain well behaved in this environment where we're now shifting towards interest rates going up in the major economies.
Geeta, two last questions on the global side. You referred to education, and you referred to this in the economic outlook as well. It's very tough to quantify the impact of education getting disrupted, particularly for the younger children for a long period of time. What's the IMF's thinking on the policy approach to this? It's a difficult one because the health concerns have not gone away. The pandemic concerns have not gone away.
This is not something that the IMF is particularly well placed to comment on in terms of addressing the trade-off between health and education. But just from looking around the world, we see countries that have prioritized keeping schools open, which is making sure that teachers get vaccinated, they get treated like frontline workers, make sure that they get vaccinated, that they have regular testing, so provide them with the support that's required for regular testing and diagnostics, and to ensure that children are in school. That should be a priority, and we've seen that is very helpful. In terms of the impact of this learning, which you can see that in some of the test assessments that are being done in terms of reading competencies, math competencies, and you can see the hit that students are suffering everywhere.
A final word, Geeta, on the labor markets and the incomplete recovery there. I think labor participation rates have remained low, lower than pre-pandemic levels across a number of countries, specifically true for women. Again, what is your assessment of what's driving this sort of very prolonged recovery in labor participation?
I mean, markets have recovered very differently across countries. So if I take the case, for instance, of Canada, labor force participation in Canada is actually even somewhat higher than pre-pandemic trends would have projected it to be. So the recoveries are quite strong. As a whole, if you look at employment recoveries in advanced economies, some of the biggest hits have been to low-skilled workers and the employment recoveries in low-skilled workers. If you look at emerging and developing economies as a whole, the bigger hit actually have been to women and to young workers. So, but again, that's a bit of a broad sweep. There is quite a bit of variation. In the US, for instance, labor force participation weakness has partly to do with women not returning as quickly to the workforce. So there are many, there's a very different picture for many different countries, and policymakers will have to make sure that they recognize the very different paces of recovery within their own country and address them with the right policies.
Geeta, I'll leave it at that. Thank you so much for taking the time to speak to us.
Thank you, Ira.
Thanks for watching Bloomberg.